are a local mortgage lender out here in Houston, Texas, with just a wealth of combined knowledge between myself, Paige, and Kelly, and our extended operational partners as well. And yeah, we're part of Movement Mortgage. And
I love it, and
we,
and I just want to give the little blurb. The Movement Mortgage, it's a national brand. It's out on the East Coast, but obviously a massive presence across the country. And one of the things I think has proved to be very well in y'all's camp is just the way that you're a leader. So let's obviously giving love to the Kelly Rogers team, but let's give love all the way to the top with Casey,
yes,
who has just his desire to preserve culture above profitability. I think is why y'all's business has succeeded so well. And I say y'all's movement as a whole because y'all do believe in the family. I see the poster culture behind you, oddly enough, which is kind of funny to add that little segue.
thank you.
But I think that's massive, and I think it's huge to be able to have. And so, and part of this conversation, I think, has to deal with culture because if I were to look at this, you're probably struggling a little bit. Let's just be honest. We watched 2020 interest rates just drop out to a bottom, like in a way that I, as a real estate agent, I felt it was dangerous to see it get so to get as far low as it did. I don't believe that's a good thing. I think there can become massive challenges with inflation and perception, which now the masses they react in the perception conversation, which I think is where we're at. And so, looking at 2021, we saw this little tiny little uptick, and it's barely even noticeable to those of us who are professionals in the industry, but yet the consumer, it feels way different. It feels massive. It feels like a weight, this little shift. And so we got down to like, gosh, there's 2.7 is a good average in 2021 for where the rates were. And now we're seeing a little bit of that uptick. Talk to me a little bit about what has happened to create that and kind of where our rates are right now.
Sure. So, the Treasury essentially has come out and said that they have done what they needed to do as far as bolstering our economy by artificially deflating interest rates, and now are bringing them back up to what normal should be. And we also experienced a recent airstrike in Syria, so we did see a more sudden spike in some volatility in the market that's directly related to that, and other smaller economic um, occurrences that have happened in our world, and that all trickles back down to what are bonds doing, and that impacts interest rates as well. And the greater theme is going to be that the Treasury is saying, hey, we did what we needed to do to essentially stop the hemorrhaging of our economy,
Yeah.
but now we need to go ahead and bring it back and establish a new floor for interest rates. So it's interesting because this time last year, actually in January of this time last year, interest rates were at 3.34,
Yep.
and we're sitting right around that again. So it's just crazy to see how these cycles occur, and to know that we're kind of at where we were last year, and we were celebrating it this time last year of like, oh my gosh, rates are so low. I can't believe they're 3.34. So it's interesting to be back in that space. And now the consumer just understanding has shifted. And then also, we're operating in a space in which we're trying to re educate people
Yep.
as far as this isn't actually horrible interest rates. Borrowing in the threes and fours is actually healthy for our economy, and
Yeah.
still good from a consumer aspect. Obviously, everybody wants interest rates in the twos, but it's not as horrible maybe as the public perception makes it
Well, yeah,
seem.
and that's the thing with the perception of it, Allison. And you and I had a conversation, which is why I wanted to actually put this video together, just so we could have a conversation of you and I. Like, we don't have an audience right now. I'm recording this just so that we can, you know, um, I didn't go live. I guess the point of it is I
Right.
didn't go live. I'm recording it so that you and I could just have the conversation. I was like, but if we're gonna have the conversation, let's record it because I bet some little tidbits are going to come out to help the consumer. At the end of the day, all of the industry professionals, they are going to do great, and they're going to be great fiduciaries for the most part for their clients. But we get it. The consumer doesn't understand it exactly. And so when I look at what's happening, um, we step back and we look at the scale of this, right? Because we talked about perception a lot. When we look at it, the consumer perception right now is that, hey man, we're at 2.7. Like, what in the world? We're in threes now. Like that's like my whole world is upended and there's nothing that I can do. So let's kind of go back. I know that there's some of the old schoolers. We won't call them old in general. We'll just say old school who are like, back in my day, those same ones that are like, we walked uphill in the snow both directions. Those people are
100%.
like, remember when they were
Yes.
14%? You guys don't know what you got. And that's great. And you can do that all day long. But like, that's like correcting a child. It's like, you should have seen when back in my day we couldn't do anything. It's like, yeah, but we're not living in your day. And so the
Correct.
perception of it is very real. Because I even go back to in 2008 when I bought my home for the first time. I think we were in the eights because I had terrible all around everything. So I think we're in the eights if I remember correctly. And then
Right.
I refinanced it to get into the sixes. I remember
Right.
refinancing my home to get into the sixes. Well, and then you keep kind of going backwards through that whole process. And sorry, backwards. Keep going forward in that process. When I purchased my home, we purchased. I think my rate was 4.25 when I purchased in 2017. Okay,
Mhm.
so I really consider the magnitude of this. 4.25, which was awesome. It was a great rate. I was happy as all get out, looking at where I had come from to where I was, looking at the projection of my monthly payment, which is really what we're looking at. The consumer thinks everything is hinged around the monthly payment, which is true. We just don't know how to translate it, right? So we're going to talk about that. So I'm loading that gun on the mantle so that we can have that discussion. But 425, 4.25. Well, then in 2019, let me make sure I have is either 20, yeah, I'm
I think so. Yeah.
think it was 2019 is when I refinanced my current home. And we closed in December before the craziness of 2020 rolled around. And I just looked at my rate. I refinanced at 3.6. And I remember having the conversation with my mortgage professionals. I was like, hey, like I've seen it kind of doing this little dip moment. Like it was just happening anyway, just kind of naturally through the market, watching what was happening in the market. We were in a great time of prosperity. There were a lot of things, regardless of what your political opinions are. We had a lot of great stimulation happening inside of the economy. And I was
Right.
like, hey, do you think it's gonna go any lower? And this was the truth. It was no, I honestly like you can, but it's like when you try to time things this way, it's like gambling. Nobody really times the market properly. They just don't. If you did, you had a magic ball, and we all need to go and hang out with you and get your knowledge. But you can't.
100%.
You can time it as best as you know. So that's what I did. Well, then you look at what happened in 2020, and
I
the
know.
stimulation of the economy was coming in play, and to see rates get into the 2.7, 2.8, I was like, I didn't time it right. That's just wrong, right? I couldn't time that. I can't predict a plague in the world, right? I say plague. I guess we can't call it a plague, whatever we call it, a pandemic. But I
For
can't
sure.
predict that. And so the reality is that we can only do with what the information we know now. That's our action comes from the information that we have now. So even though we look at it and say 2.7, well, that ship has sailed. We can't fix that. But it didn't change our ability to have a great rate and a great opportunity to be able to purchase real estate in today's economy. Like you're
Right.
still purchasing future wealth at a massive discount. So, in your opinion, looking at everything that's been happening, and I say your opinion because it's actually fact, but most people are going to like look at it from your perspective, right? From your perspective, what is the true cost of seeing an increase as nominal as it has been?
Right.
But also, I want to open up the door and be okay with opening up the door of like where we see it trending. What's the true cost of this?
Sure. So, from a practical standpoint, the way that rates have shifted just because of the recent spike that we experienced, but also what the Treasury and the Feds have kind of hinted toward rates being. Did I lose you?
You're fine. Keep going. You're good.
Okay. All right. So, the practical application of that is that interest rates have experienced a sudden spike, but also the Feds and the Treasury have hinted towards interest rates stabilizing and a new floor being established continuing through the rest of this year and into next. And those shifts in interest rates may make a monthly difference of $30 to $50, dependent on a multitude of different factors, but just generally speaking, the change is fairly nominal.
Yeah. And here's something that I want to be able to say just from my experiences. One, being a consumer, because like I've bought and refinanced 2 homes, so I've had 4 of these transactions in my history, and I know that that's not a ton, but that's still a lot for most people who
Yes.
go through this every 5 to 7 years. I've had the experience of like getting involved not only purchasing a home but also refinancing both of the homes that I've owned. So I've only owned 2 homes, and so in that process I describe it in this way, and most people don't understand this. When you look at every factor of the residential real estate world, and that's from insurance to mortgage to the realtor to the negotiations of all of it, it's like the 80s stereo systems, right? You had your tape deck, you had all your stuff, but I don't know for whatever reason they thought that we were master audio technicians, and they had this like 7 channel equalizer on every single stereo. And like a song would come on, and you're like, "Oh yeah, we're gonna get into this thing," and you start tweaking all those little things, and it sounds awesome. And you're pumping your song, and you're going. Well, then the next song rolls around, you're like, "Oh, that's off," and so you tweak it again for the next song. The reality is that everything that's happening inside of our world that we're deal with on the mortgage side of things, like looking at mortgage specifically, it's an equalizing stereo. It's that equalizer, right? So my interest rate
Right.
is only a factor inside of what the total parameters of what it's going to cost me or what it's going to benefit me to get a mortgage in today's economy. And I
Right.
think if we are scared of this slight uptick on purchasing homes, I think we will have a regret that will settle in because we've missed the opportunity to capitalize on the market that we know now. And that's how
Right.
we can make the best decisions. And if you look on it, hindsight will always be 2020, right? I wish I would have waited a few more months and then I would have redone my rates and all that stuff. But like, I'm not hurting. I have still benefited massively, but I
Right.
can't compare what I have to what everybody else was able to get.
Yeah.
And so
Fair.
when I start comparing what I have based on what everybody else can get, then yeah, I'll never have a great deal. And I will what if myself into an oblivion and never capitalize on the market of right now that could massively benefit me. Right. And I think that's the biggest challenge is that our perceptions are off because we have had such I love that you use the word floor quite a few times. Our floor has just been so different that we're looking on it and we're
Right.
going like, oh my gosh, like this little tick because our we've been moving in this little space. Like our elevator hasn't gone to 10 floors. Our elevator has only lived in 1 to 2 floors. And we look at this small move and it feels massive and it's just not.
Right.
So,
Right.
um, so if I am a buyer in today's economy and I come to you and I want to look at this and I want to see where are my risk factors, where are my benefit factors? What are you seeing as like really what are the things that are the riskiest? You know, because I think it's good to talk about that, but like where's the benefit in all of this?
Absolutely. Well, I will say that universal truths always apply no matter what the market is doing. And if you are somebody that has considered homeownership and just are waiting to time again that perfect move and that perfect play, it may or may not exist in the way that you believe it is because we didn't foresee the market shifting as drastically as it did. And there are only so many things that we can ultimately predict. That the first thing that you should always do is have an educated plan. And the way that you begin that process is by having a conversation with a mortgage lender and building that game plan to say, hey, if you make a move in the next 6 months, this is what we're estimating interest rates to look like. And this is what your payment's going to be. If you're looking to make a move in the next year, this is what we're seeing could possibly occur. And that's what the difference in payment looks like for you so that you understand and know those numbers ahead of time and don't really speculate or use Google to tell you or dictate your financial decisions because every person's financial circumstances are fundamentally different than the next. So it's not this universal rule that applies to each and every single potential home buyer or somebody that's wanting to make another purchase if it's not a first time purchase. So having a conversation and getting your options that are specifically tailored towards you will help you make a more informed decision.
Yeah. One of the things that I love about what you said is that if I can take a step back and I can go, okay, I'm not measuring this by what was in the past, and I'm not measuring it by what is in the future. I'm measuring it by what's happening right now. Right now, do I have the ability to make a down payment that's going to be significant
Right.
enough to be able to feel the equity and not lose by putting that cash away? Like that cash is now out of my system. Can I
Right.
make the risk of putting that cash out? There's a risk. Can I put the cash out? What is a self satisfactory measurement of purchasing a home right now? Am I in a dire situation to where like if I'm not able to move now, then I'm going to have some sort of consequences that outweigh an extra 30, let's even just say $100 a month. That's going to outweigh an extra $100 a month. Is
Right.
my budget so strapped that if I purchase this house and it added an extra 30 to $100 on my budget, is it something that will just put me so far behind that I will be house rich, but scenario of life just in the dumps? And so
Right.
now I'm looking at that factor. And then is it going to bring me some sort of measure of the equity or the investment side of it? Is that going to be worthwhile? So if I can really look inside each of those categories, and this is where the professional system comes along, right? Because I don't know how to make that conversation happen without having a conversation. Right? I don't know how to make that decision without having a conversation with somebody like you. If
Mhm.
I can look at all the factors and all the factors point towards yes. If it looks like a squirrel, if it smells like a squirrel, if it jumps like a squirrel, if it climbs a tree like a squirrel, then it's a squirrel, right?
Right.
Which means if everything lines up towards yes, then it is a great opportunity for me, and I need to make that decision based off of the best decision for me and my family. And that's all
Absolutely.
there is to it. We can't be fearful of what the market's going to do because it will put us in this position of just being afraid all the time. And if we get into that mode, like it's more detrimental than even just home ownership. It's like where else is that leaking into?
Right.
When we went from 2.7 to 3, that fraction is so minute compared to the life satisfaction that you could find in home ownership if the time is now for you, right?
Right.
And I think that's what we're missing is that perception of like it's almost like what's happening right now is customer service. When we call the person who's just supposed to answer the phone and we start laying into them, like they were literally paid to answer a phone today. They have no idea who you are or what your account number even is. They're just
Right.
answering the phone. When we
Yes.
look at the market and we look at that one interest rate tick, we all just called the customer service hotline, just fuss at somebody, and we're fussing at the wrong person. That little
Absolutely.
piece of the puzzle is one segment of the entirety of your plan to be able to move into wealth through home ownership. And you've got to
Right.
consider all elements. And you can't be sidetracked by just this one little tick. Because the reality is, what's going to happen, Allison, you can maybe speak to this a little bit more clearly, but like what's going to happen is as that interest rate raises, our saturation of money at a like low cost changes and we actually have a better economy when the rates aren't just bottomed out because like it
Right.
can get really detrimental. It really can. If that rate continues to drop and it hits this nasty floor, well, at that point we can't borrow and earn money and earn interest and have an economy that benefits from it.
Absolutely. Yeah, it was very interesting at certain points through last year to be locking people at 1.99% interest rates. That's when we start to look at how much of this is pointing towards a situation like Greece,
Yeah.
and is that healthy for us or not? And the truth is, it's not. We did artificially, or our government did artificially deflate interest rates for a very specific reason. And it was because were in a dire position as a nation in recovering from COVID. And now that we are seeing some type of recovery within our economy, it's time to make those adjustments back to a more normal again
Yeah.
in other areas of our economy, and that includes interest rates.
Yeah. Well, and I think you hit the nail on the head is that we did what we needed to do to survive. But here's the reality. And this is a talk about universal truths. This is like emotionally, personally, like your life situations and relationship situations. What we do to survive will not help us thrive. Survivorship is great, but the things that we do to survive, the boxes we put ourselves in, the emotional canvas we put on ourselves, whatever is necessary for us to survive, and even inside of the economy, what we do to survive, they are not the elements that help us thrive. And
Right.
so now that we've gotten through survivorship, now we have to get into thriving. And the thriving is always going to be what helps everyone because we have to just take and believe that the best is going to come out of this and that our ability as professionals inside of this industry to help people is only going to elevate when the decisions are made for the greater good. We have
Agree.
to believe in that. We can't be pessimistic inside of that. We have to trust
Yeah.
that, like what we have right now, I can measure my ability to be in today's market and to make a healthy purchase for my world without it derailing based off of 0.2% increase in interest rate. That's
Yeah.
just not true.
Agreed.
Well, good. Well, I really do appreciate it, and part of it, obviously, I have my own ideas and my own opinions around it. You're a professional inside of this world. I really appreciate you sharing everything that you have. Obviously, we didn't open up the book too wide because I mean we would be on here for like 5 hours having the conversation. But I do want to
Right.
make sure people can connect to you. So my information is scrolling across the bottom, but I'd love to be able to have anybody who tags into this to be able to reach out to you and say, "Hey, I actually have a question that's a little bit more in tune to y'all's generic little lay of the land that you just did in this 18-minute video. Can I reach out to you?" So, how do people get in touch with you, Allison?
Absolutely. So my direct cell phone number is 832-545-9654. You are always welcome to give me a call or shoot me a text message, and I'd be happy to just hopefully educate and equip you.
Okay. Now, I just want to make sure because I can go back and re-edit this if necessary, but like that's gonna go out to the little Facebook world. There might be like thousands of people with your cell phone number. You good?
Uh, no, I'm fine with that. Yeah. I mean, it's on our website, so it's not like
So it's like you can find just Google me. You'll
you can
find me
find me if you're
anyways. Okay. Well, as always, I appreciate it. I appreciate you guys, Kelly Rogers team, Movement Mortgage, and thank you for getting on with me just to have a quick conversation. I say quick. It was a little bit more than quick, but I felt it was necessary to be not just like shaking a finger at the world, but just to really have a perspective shift on what's going on isn't detrimental, and I still can purchase my future wealth at a discount, and it can be the best decision for me and my family based off of what information we have now. Anyways, thank you
absolutely.
so
Well,
much, and hey, go have a beautiful day.
you too.